Have you ever had a trading strategy that was just crushing it for months, and then out of nowhere, it just completely falls apart? Well, the answer isn't about finding some new magic indicator. It's about understanding the market's hidden personality. So in this explainer, we're going to break down the institutional framework of market regimes, and we're going to use actual academic research to show you how the pros really see the market. And this right here, this is the core idea. Seriously, it's not always about having a better strategy, it's about knowing what kind of environment you're even in. If you can get this one thing right, everything else starts to click into place. All right, so here's the game plan. We're going to cover what market regimes actually are, and I mean beyond just looking at a chart. Then we'll get into how professionals use data to spot them. We'll figure out exactly why your go-to strategy suddenly tanks, and we'll pull back the curtain on how volatility is the secret force driving the whole show. So let's get right to the heart of it. The real reason that consistency is so incredibly hard to find in trading isn't because your edge just vanishes forever. It's because the market itself has different states or personalities, and it can switch between them without warning. Okay, you really need to get this definition. A regime isn't just a trending market that you kind of eyeball on a chart. No. It is a measurable, statistical environment. The best way to think about it is like seasons. Winter and summer have fundamentally different persistent rules, right? And guess what? The market is exactly the same. So this slide really frames the big mental shift we're making here. We are moving away from the subjective world of chart patterns and gut feelings and toward an objective, data-driven view of the market based on its real statistical properties. This is how quants think. This is how institutions operate. Okay, so if these regimes are real, quantifiable states, then how in the world do professionals actually find them? Well, it's not about guesswork. It's all about the math. And it all comes down to this one core idea, which comes from decades of financial research. The price action you and I see on the screen, it's just the surface. It's actually being driven by a hidden underlying state. The whole game is to figure out what that hidden state is. And this is how they do it. Now look, you do not need to be a math whiz to get the main idea here. Professionals use these sophisticated models for one key job: to sift through all the market noise and tell them, with statistical confidence, hey, we are now in a calm state. Or, watch out, we have just switched to a highly volatile state. These tools are what separate institutional analysis from retail guesswork. Now, what's so cool about this slide is that it's basically the proof right in front of your eyes. Researchers took a ton of market data, fed it into an algorithm, and told it to find groups. And look what happened. The data itself, with no human help, split into two very distinct clusters. You've got this calm, low volatility state in blue, and a chaotic, high volatility state in yellow. The data itself is telling us that these regimes are very, very real. Okay, so let's bring this all back home. How does all this fancy theory actually connect to your trading account? Let's break down exactly why your profits can suddenly just take a nosedive. Well, 9 times out of 10, the answer is a classic case of regime mismatch. Your strategy was an absolute expert in one environment, and then the market switched, and now your strategy is a complete rookie in a game it doesn't understand. It's pretty simple when you break it down. A trend-following strategy, right, it's built to thrive on big directional moves. So when the market gets choppy and range-bound, that strategy just gets shredded by 1,000 little false breakouts. On the flip side, a mean reversion strategy that's making money when prices snap back to the average, that thing is going to get absolutely steamrolled in a powerful one-way trend. And this right here is the master key. The big shift between different market personalities, trending, ranging, crashing, it's almost always driven by a fundamental shift in volatility. See, volatility isn't just some side stat about risk. It is the engine that determines the entire market's character. And this heat map illustrates that point perfectly. Look at the blue areas. That's a low volatility regime where different assets are kind of doing their own thing. But then you see these bright yellow blocks? That's high volatility. Correlations spike, and suddenly everything starts moving together in lockstep. This is when your diversification fails. This is when multiple strategies can break down at the exact same time. The very structure of the market has changed. And here's the kicker. These states aren't just random flickers. They stick around. It's a well-known phenomenon called volatility clustering. It's why a strategy can work for weeks or even months. A stormy period is often followed by more stormy weather. And of course, it's also why a strategy can fail for weeks on end, because the market has switched to a new persistent regime, and it's not in a hurry to switch back. Okay, so we've diagnosed the problem pretty clearly. Now what do we actually do about it? let's build a practical, regime-aware framework that you can actually use. The logic is actually very simple, and it flows in this exact order. First, you diagnose the environment. Is it calm or is it chaotic? Then, and only then, do you select the right tool, the right strategy for that specific job. And finally, you have to adapt your risk. You simply cannot be using the same position size in a crazy high volatility regime that you were using in a quiet, low vol one. It's a recipe for disaster. And thinking this way helps us bust some of those common myths you hear all the time. It's not that your moving average just stopped working. It's that the market's underlying state changed, and the entire logic that indicator is based on no longer applies. And your edge? It didn't just vanish into thin air. It's just dormant, waiting for its favorite kind of weather to come back. So let's just pull all of this together into a new and, frankly, much more robust way of thinking about your entire trading process. So what are the big takeaways? 1, markets have these distinct personalities or regimes, and we can identify them with data. 2, volatility is the big kahuna, the main driver that causes those personalities to change. 3, your strategy lives or dies based on how well it fits the current regime. And 4, this whole idea of one strategy for all markets, it's just a mathematical impossibility. And if there is just one thing you take away from this entire explainer, please let it be this. The single biggest leap you can make in your trading is to shift your focus. Stop hunting for the perfect, flawless strategy and start obsessing over how to accurately diagnose the current market environment. I promise you, the strategy part gets a whole lot easier once you get the diagnosis right. So if you found this data-driven, no-hype approach valuable, you know what to do. Make sure to subscribe because we're going to be doing much deeper dives into how to actually measure these regimes in practice and how to match specific strategies to them. Thanks so much for watching.